Thanks, Shane. Thanks for the lovely welcome and also your technical support behind the scenes. Good morning, everyone. Thanks for joining us. It's so lovely to have you. Today, I'll be giving you an introduction on liquidity and solvency. Now, these are two standalone concepts, but because they are so inextricably linked when speaking about the financial health of your company, it's important to consider them together. Let's start right at the beginning and kind of delve into what these two concepts are. So what is liquidity? Liquidity is the extent to which a person or business can meet immediate and short-term obligations. It also refers to the availability of cash or other assets that can quickly be converted into cash in order to meet these obligations. So in a nutshell, the ability to pay off debts as they become due. Now, there are two items that I really just want to highlight. The one is the word short-term. So we're looking at typically a 12-month period when we talk about liquidity, and also debts when they become due. In other words, it's not just your ability to be able to pay your debts or your short-term debts, but also on a timely basis. In other words, can you pay on time? So we are looking here at your current assets and your current liabilities. So for those of you who are not familiar with the terms, an asset on a very kind of basic level is typically something that you own, and a liability is typically something that you owe. So we are looking at assets and liabilities, typically, as I said, within a 12-month period. Now, it's interesting, really, that liquidity can be looked at not only from the perspective of your business, which we are going to be discussing today, but also, for example, you can speak about the liquidity of an asset. So that the degree of liquidity of an asset depends on how quickly it can be bought and sold in the market at a value loss that is not that great. So there you can see is a little bit of a balance between how quickly you can convert an asset without losing a lot of its value. So that also talks about liquidity. And as you can imagine, cash is considered the most liquid of all, if you think about it, because you can use cash to pretty much do anything with. Just to put it in perspective, here I have an extract from a statement of financial position or a balance sheet, for those of you who are more familiar with that term. And I've just highlighted two areas. You can see the balance sheet or the statement of financial position is made up of your assets at the top, your equity in the middle, and your liabilities at the bottom. And these two blocks that I've highlighted, you can see are your current or short-term assets and your current or short-term liabilities. And those are really the two areas that one looks at when you consider the liquidity of the business. Now, if you just look at this set of financial statements or this extract, you can see that your total short-term or current assets exceed your total or short-term liabilities. But so it seems as if they probably should be quite liquid. But if you delve a little bit deeper, you can see but we've got quite a large balance sitting under inventories, and we've got this strange short-term loan, as well as a bank overdraft that's been utilized at the bottom. So you can see there's a lot more investigation that needs to be done into your financial information to determine what your liquidity position is. But we will be looking at that in a little bit more detail later on. So typically, one would look, if you look at it from a high level like this, you would consider, do your assets actually exceed your liabilities from a current point of view? Are you then able to pay off your debts? An interesting thing to note that you might not be aware of, and it's just something that you can always keep an eye on, is when a set of financial statements are prepared in your balance sheet or statement of financial position on your asset side at the top here, this portion on your current assets is usually really ranked in terms of the liquidity of these assets. So that's usually the norm. It isn't always like that, depending on who and how the financial statements get prepared. But usually you can see that you start off with your very liquid assets at the bottom, your cash. And then it moves up to slightly less liquid assets, your debtors, your trade receivables. These are considered fairly liquid because a sale has already been made. That amount of money or cash is due to you. It's really just a matter of when you collect them. And then moving up another rank, you go even more illiquid to inventories. Inventories are considered a lot less liquid than your debtors or your cash because you haven't actually made a sale, they could still be work in progress. So there's quite a lot of time that might, or even manufacturing, if that's your industry, or process that needs to be taken through in order for you to convert your inventories into cash. And that's why you can see that they are ranked right at the top, which is most illiquid, if I can put it that way. Then let's have a look at solvency. Solvency is the extent to which a person or business can meet its long-term debts and financial obligations. So in order for your business to be solvent, the value of the business assets must be greater than the sum of all its liabilities. So the emphasis here, in contrast to when we spoke about liquidity, is long-term. In other words, can the company or business continue trading in future? So in a nutshell, solvency is the ability to continue operations into the foreseeable future. So we are looking a lot more forward than liquidity. So solvency is the measure of the long-term financial health of your business. And it's important to remember when you compare assets and liabilities and you look at your solvency, in other words, do my assets exceed my liabilities? And I'll put that into context in the next slide. Just remember that meeting your financial obligations doesn't just mean paying off interest. In other words, servicing your debt. It also means that you need to be able to pay the actual capital outstanding. And solvency is essential to staying in business because without solvency, it's very difficult to continue trading. Just to show you and put it into a little bit more context in terms of solvency, this is another extract from a statement of financial position or a set of financial statements. And in this case, I'm going to draw your attention to this middle part of the balance sheet, which is your equity. Now, your equity is a representation of the book value of your business. So if you take all your assets at the top here and you deduct all your liabilities at the bottom, you are hopefully left with some value in your business. And that value is your equity or the book value. So the book value really assumes that if you go and you almost convert everything that you own into cash tomorrow and you pay off all your debts, you will still be left with some value if your equity is positive. So when we look at solvency and we look at this balance sheet, for example, we can see that we've got positive equity over here. So that means that there's some value in the business. My assets exceed liabilities, and that you can see by looking at your total assets over here, about 1.9 million, and your total liabilities over here, which is about 1.2 million. So that's typically the position that you want to be in. You want your assets in total to exceed your liabilities. However, it's important to take note that you cannot look at your liquidity and your solvency in isolation. You need to compare it, or you need to combine the two concepts when you're looking at the financial health of your business. Because if you just quickly look here, if you look at this current asset section, which is what we say typically looks at your liquidity, you've got just over about 1 million. At the bottom of here, when you look at your current liabilities, you've got that 1.2 million. So suddenly, where you've got a company that looks solvent, it might be an indicator where your current assets exceed your current liabilities exceed your current assets, that there might be a liquidity problem. So you can see that there's more investigation that needs to be done. So it just gives you an indication or a feeling of how liquidity and solvency needs to work together for your business to be successful, and that you need to actually delve a little bit deeper into your financial information. In contrast to this slide, I'd like to show you this extract from a set of financial statements. In this case, where we go and look at your equity or book value, we are sitting at a negative value. In other words, you don't have retained earnings, but you have an accumulated loss. So what does that basically mean? It means that your total assets, 1.6 million in this case, is actually exceeded by the total liabilities of 3.7 million. So you or this business, if this is, say, let's say your business at the moment, would be in a factually or technically insolvent situation. This is when your assets are exceeded by its liabilities, meaning that the owner equity or the value has been eroded. Now, if you just look at this extract, you can see that this company is really facing some difficulties because from the prior year, the accumulated loss has actually increased, which means they are making current losses. And you can see that they've actually had to take out a shareholder loan, which wasn't there in the prior year, to actually assist them in their trading. Now, what's important to remember is if your company or your business is in a situation of technical insolvency, where your assets exceed liabilities, you need to be extremely careful. Because if you're in that situation and you continue trading, you could fall into what they call reckless trading from a company's act point of view. And this could cause a lot of problems for your business, including your directors if you are a company, because they could be held personally liable for continuing to trade while you are actually factually insolvent. What would happen in this case is that the company would have to enter into a legal agreement with the shareholder called a subordination agreement, which needs to be signed by both parties. And what this subordination agreement basically says is that this shareholder will agree not to claim any rights to their debt. In other words, if something goes wrong, the company needs to be liquidated, they will stand last in line to the other creditors to actually claim their debt. And if that happens and you have the subordination agreement in place, you can see it almost then eliminates this obligation that is sitting here in the financial statements. You can see this 2.4 million is just enough to cover this loss of 2.1 million to actually reduce your factual insolvency situation to a solvent situation. In other words, it will actually flip it over. If you think about the accounting equation, assets minus liability is equity. So if you reduce your liabilities, it will increase your equity. So in that case, you can continue trading even though you're factually insolvent because your major debt or your loan from your shareholder has been subordinated. But because it's so close to this accumulated loss value, this company needs to be very careful and put strategies and procedures in place to make sure that they actually trade themselves out of insolvency and recover their position. This also doesn't even consider whether they can actually do so in terms of their liquidity position. So you can see that in this instance, there's a lot more work that needs to be done. Now, I mentioned that in this case, we are looking at a factual or a technical insolvency position, but I also want to introduce you to a concept that's called commercial insolvency. Commercial insolvency is a situation where your assets do exceed your liabilities. In other words, you are solvent, but you are actually not in a position to be able to service your debts. In other words, you cannot pay the interest or the capital portions as they become due, which is basically a liquidity issue. So if I jump back to my previous slide, this company we mentioned was solvent because we've got positive equity, we've got value in that business, book value, but there was possibly an issue with liquidity because my current assets were exceeded by my current liabilities. So it's possible, I'm not saying it is like that because more investigation is needed, more information is needed, but it's possible that this company could be or heading towards a position of commercial insolvency where they are actually solvent, but they aren't able or they aren't liquid. They can't actually service their debt. So that's an interesting thing just to keep in mind when one talks about solvency. Let's go and look, now that we understand the concept of liquidity and solvency, let's go and convert that into a more practical point of view and see how that actually can be applied to your business. So the first thing that we're going to look at is how do we measure liquidity? What can you do on a regular basis, month to month is advised, to actually track your liquidity and see what your business or what your financial health of your business looks like. So the first thing that we're going to look at is a little bit of ratio analysis. We're going to do a few calculations. I'm going to show you an example as well, just to put it into context, in terms of how you can measure your liquidity of your business. Now, the first two ratios that we have here on the screen is your current or working capital ratio, as well as your quick ratio, or it's also called an acid test ratio. Now, the first two ratios basically look at how liquid your company is in terms of a working capital point of view. And then the third ratio that I've brought in that I'm going to explain to you as well is the operating cash flow ratio. And that looks at how your working capital or how liquid you are in terms of a cash point of view in your business. But I'll explain that in more detail in just a bit. What I just want to emphasize is when it comes to liquidity and solvency and measuring these indicators from a ratio analysis point of view, it's important not to look at your ratios in isolation. You need to look at your whole business. You need to put it into context. You also need to consider which industry you're trading in and what type of business you have. So there are many factors that need to be brought together when making an assessment or interpreting the results of your liquidity and solvency calculations. So let's first of all look at your current or working capital ratio. This is calculated by taking your current assets of your business and dividing it by your current liabilities. So it refers to your short-term assets and liabilities and how well you are managing your working capital cycle. And ideally, this ratio should be greater than 1. I think the norm is usually 2 to 1, then you're in quite a good liquidity stage. If you track your current ratio and you see it's coming to more, it's dropping to about 1.5 to 1, the warning signs need to be there. And 1 to 1 current ratio, meaning your current assets cover your current liabilities on a 1-to-1 basis, that's cutting it way too close from a liquidity point of view. But I'm going to, when we do the example, you'll see what I mean when I talk about 2 to 1 and 1 to 1 in terms of the results of this ratio. Now, I also mentioned something in this ratio, the working capital cycle. Now, for those of you who are not familiar with that, your working capital cycle is the time that it takes to convert your net current assets and current liabilities to cash. So current assets, we are thinking about debtors, we are thinking about inventory. And on your current liability cycle, in terms of working capital, we usually think about your trade creditors. So how long does it take to actually convert this whole process into cash? That talks about how do you collect your debtors? When do you pay your creditors? How long does it take from your manufacturing of your inventory to actually sell it and then collect those debtors to a cash point of view? So that is how we measure your working capital management, is your current ratio. The second ratio is your quick ratio or the asset test ratio. Now, this is really the best ratio to use when you look at liquidity, obviously in conjunction with your other ratios. So please don't look at it just in isolation. But what the quick ratio does is it almost delves a little bit deeper into your liquidity. It takes your current assets and it minuses inventory and then looks at that over your current liabilities. So what it basically says is inventory is excluded. Why? Because it's the most difficult to convert to cash when compared to other current assets like cash and accounts receivable. So what you're basically looking at is how are my liquid assets covering my short-term obligations? And if you are in a business and you might not be in the manufacturing industry, you might not even have inventory, you might be in the service industry, you might have other current assets that are specific to your business that are not very liquid. For example, prepayments. And you can then use this quick ratio and almost adapt it by taking off your illiquid assets and then comparing that to your current liabilities. Now, for your quick ratio, the norm is usually 1.2 to 1, which I'll explain when we do the example. But ideally, you would want it greater than 1. You would want your liquid assets to at least cover your short-term obligations. So your quick ratio gives you a much more accurate or a much truer picture of the liquidity of your business. Just be careful, if it does start to dip below 1, the results of this ratio, it's very important that you try and fix it as quickly as possible and you get your liquidity in your business to a much better state. Because if you aren't able to pay your short-term obligations on time, it puts your business in a lot of risk. Because if you don't pay a creditor, they have the ability to go and apply for liquidation of your business. So it's important to pay your creditors and also pay them on time. And that's where liquidity is so vital. The third ratio under your liquidity measures is the operating cash flows ratio. And this is calculated by taking your operating cash flow over your current liabilities. And in the example that we're going to do shortly, I'll show you what the operating cash flow really is. Now, this ratio measures how well your current liabilities are covered by the cash flow that is generated by the company's operations. The higher this number is, the better, because it ensures that the company's current liabilities are covered more times over. And if it's increasing, it's indicating that the financial health of your business is increasing. Because remember, if you look at your financial statements, let's say you look at your statement of comprehensive income or your income statement, your accounting profit is not necessarily always an indication of the actual cash in your business. And to be able to be liquid and to service your short-term debts, you need to have cash available or assets that can easily be converted into cash to be able to pay that. And that's why, as part of your liquidity, you need to look at the cash flow portion of it as well. Let's have a look at an example. Just want to show you an example of how these ratios work. So I'm hoping that everyone can see the screen. If it's a little bit small, please just shout, but I have attached these examples as a handout for you to refer later. And if anyone gets lost in the calculation, please send a comment or put your hand up and Shane will catch it at the back end and I can just go over some of the detail again. First things first, here I've got an extract from a set of financial statements that we're actually going to use for the calculation. This is a statement of financial position or your balance sheet. And then if I go down here, when we look at our third ratio, we will be looking at an extract from your statement of cash flows. So let's start off with our first liquidity ratio, which is your current ratio. Current assets over current liabilities. So if I look at this block, I'm going to just open the formula for everyone to follow. Where did I get these figures and how do you actually calculate it? So my current assets are sitting over here in my financial statements. And this pink arrow over here is the value that I've taken for the current assets. It's your total short-term assets. In this case, the business or the CC has trade receivables and cash. Just for those of you who are not sure, how do I know that it's a CC? Just something nice to look at. We have members' contribution here. Anytime the financial statements talk about members, then you know you're talking or looking at a CC. So we start off with this 3.5 million, the 3573586, which are your current assets, and we're going to divide that with your current liabilities. So your current liabilities are sitting at the bottom of here. It's your short-term obligations, and this greenish arrow is showing the value that I've taken. Your total current liabilities in this case are made up of trade payables, your current tax liability, and the current or short-term portion of any long-term borrowings. And if we then calculate the total current assets over the total current liabilities, we get a value of 2.13. That's quite good. That means that for each current liability I have, your current assets are covering them twice over. So it's a covering ratio. And that's why earlier I mentioned in the previous slide that your industry norm is really 2 to 1. So you really want this ratio to really be at a value like this, close to 2 or even above 2, because that means you're quite healthy from a liquidity point of view. You're covering your current liabilities twice over with your current assets. If this drops down, as I mentioned, to say 1.5 or even 1, then the warning signs should be showing that your liquidity is being stressed. Our next ratio is our quick ratio. Current assets less inventory. So we're taking our illiquid assets out of the picture. We're looking at your very liquid assets only and how those can cover your current liabilities. Now, in this case, the CC doesn't have inventory. It's not in the business of manufacturing. So if we look at the example now, it'll be exactly the same results as your current ratio because there's no inventory to actually take off here. You would use the same value for your current assets, the same value for your current liability. You would calculate it once again, current assets divided by current liabilities, and you'll get the same answer. So if you were a business that had inventory, you would actually take out the inventory value or your illiquid current assets, and then you would actually assess and say, okay, let's say I have inventory here. I'm just going to give a quick example. Let's say I had inventory here of, I'm going to say, how can we put it? Say 1 million rand. So I'm going to put a value here of 1 million rand. It's just an example to show you. In my ratio, I would have taken my current assets and I would then deduct this 1 million rand of inventory, being my illiquid or most illiquid assets, and I would still divide by my current liabilities to get an indication of how well my liquid assets are covering my liabilities. And you can see immediately this quick ratio drops down because I'm actually taking out some of the current assets that are covering my liabilities because we are considering them not to be liquid. So when you look at your quick ratio actually moving downwards, you can then say, okay, well, my current ratio shows that I'm quite liquid. But in conjunction with my quick ratio, I might just be careful and say, okay, well, I need to keep an eye on things, because if my inventory is not actually turning over as quickly as I want it to, then this ratio could indicate that I might be getting into some liquidity stress, because my actual liquid assets, my debtors and my cash is only covering my current liabilities on a 1.5 to 1 basis. The industry norm, as I mentioned, for the quick ratio is 1.2 to 1, but it's always nicer or better to have it higher rather than lower. So that's just to illustrate how these ratios work. If we move down to the operating cash flow ratio, we said that the operating cash flow looks at how your operating cash flow covers your current liability. So we're actually converting it to a more cash point of view. So how do we calculate that? Well, the first thing that it looks at is your operating cash flow. And where do I find this figure? If you go to your statement of your statement of cash flows in your financial statements, this would be the first part right at the top, which looks at your cash flows from operating activities. Basically what it does is it takes your profit for the year, which is an accounting figure, and it adds back any items that are not cash. So typically it would be depreciation. It could possibly be some type of accounting adjustment or entry that could have been put through. Anything that's not cash. And it also looks at the movement in your working capital items. So your inventory, your trade receivables, and your payables, just to try and eliminate any transaction that went through your books that are non-cash. And then it actually looks at taking off your actual costs for financing, so your interest costs, as well as your tax, and it gets to an operating cash flow figure. And that's the figure that you will then use in this ratio. So there you can see at the gray area, I've used the 2.4 or 2.5 million, and I've divided that by your current liabilities once again. And you can see here that I'm sitting on about a 1.49, 1.5 covering ratio of your cash, your operating cash flow to your current liabilities. So it's showing that this company is in quite a strong liquid position. They've got a great quick and current ratio because it's obviously taking out the inventory. We just go back to our original example. Just going to show you. Their quick and current ratio both reflect a really nice, strong, healthy value for liquidity. And you can see that their cash is actually quite strong as well in terms of covering their current liabilities. So hopefully this example puts it into a much better perspective in terms of how the liquidity ratios are calculated and what they actually mean. I'm going to jump back to my slides. And the next thing that we're going to look at is the solvency. And how do we measure solvency from a practical point of view? The ratios that we are going to look at here include mainly the debt to equity ratio as well as the debt ratio. And then I've added two extra ones, the interest coverage ratio and the solvency ratio. And I'm going to be discussing those one by one as well. Now, a solvent company is one that owns more than it owes. So here, in terms of our solvency ratios, we are going to be looking at your assets as well as the value in the business. So the first one, debt to equity, is calculated by saying, take your total liabilities in your business and divide it by your total equity. Now, this ratio indicates the degree of financial leverage or gearing that is being used by the business. And it includes both short-term and long-term debt, because remember, solvency looks at a long-term view of the health of your business. So when we talk about financial leverage or gearing, it basically looks at the ratio and between your debt and your equity. In other words, how is your business financed? How do you get money, or how do you get financing to actually manage your business? Are you using debt or are you using equity? And what is the ratio between the two? So the debt equity ratio, you don't want to be too skewed. And what I mean when I say that is that the rule of thumb is usually about 50-50, depending on which industry you are in. And you can even bump it up to about 60-40, where you have 60% debt financing, 40% equity financing. But one must be careful that your debt equity ratio doesn't get too high, because the higher amount of debt that you have in relation to your equity, the higher your interest expenses get, because you obviously are financing with obligations that need to be serviced. And beyond a certain point, if your debt gets too high, your gearing or your leveraging gets too high, it becomes more expensive to raise debt because all the financial institutions will find that your financial or your debt risk is getting too high because you need to service all the debt that you take on. Now, in here or on the screen, I haven't actually mentioned or written in that your liabilities that we are looking at here should probably be interest-bearing liabilities. And I'll show you in our example shortly what I mean by that. When you calculate your solvency ratios, depending on your business and how it's being financed, if you have debt that is being financed through, say, shareholder loans, and you have debt being financed, say, through the bank, it's most likely that your bank financing will have interest attached to it, whereas your shareholder loans might not. And then you need to possibly look at how that changes your solvency and your debt equity ratio, because we really want to look in terms of your solvency at your total debt, first of all, but also at your interest-bearing debt, because that's what needs to be serviced on a short-term basis from your liquidity point of view, also when we look at both of your ratios together. But I'll show you that in the example shortly. Moving on to our debt ratio. The debt ratio takes your total liabilities as well as your interest-bearing liabilities and puts it over your total assets. So this is another leverage measure, and it quantifies the percentage of your company's assets that have been financed with debt, both short-term and long-term. The higher your ratio, the greater degree of leverage or the greater amount of debt that you've taken on, and consequently the amount of financial risk that you have in your company. So once again, you want a little bit of balance. You don't want to take on too much debt because otherwise you will be in a position where you actually might not be able to service that debt. The interest coverage ratio is quite a nice ratio because it looks at how well you can actually service your interest. So it looks at a value which we call EBIT, so that's earnings before interest and tax, and it divides it by your interest expense. So it looks at any interest that you might need to pay on your financing and how well your profit actually covers that. Just important to remember with your inventory coverage ratio, it does measure how well you can pay off or how well you are covering your interest, but it doesn't take into account whether you can service the capital portion of your debt itself. So that's why, once again, it's important to look at your ratios and your monitoring of your financial information in context, not in isolation. The solvency ratio, our fourth ratio that I'm going to mention, once again brings a little bit of a cash point of view into things. So it takes your net income after tax. So it says, okay, here's my business. This is my profit for the period. I need to pay my taxes to be able to have a business that's running. But there might be some non-cash expenses going through this business as well. And in most cases, it'll be depreciation. If I add that back to get a more cash point of view of the business, and I then divide that by my total liabilities, how well am I covering my liabilities from a cash point of view? So it's just another measure to look at the solvency of your business. Now, depending on your depending on your industry, a result on your solvency ratio of higher than 20% is usually preferred. So it's basically whether your cash flow is sufficient to meet your short-term and long-term obligations. Once again, let's have a look at an example from a solvency point of view in terms of how these ratios work. If I look at my debt equity ratio, you can see on the right-hand side here, we have exactly the same company. We're looking at exactly the same company as we considered in terms of the liquidity example. So we now want to look at this company. We said, okay, well, they're quite strong in liquidity. They are able to pay their short-term obligations. They've got a great current and quick ratio of about 2 to 1. Let's have a look at their solvency. So the first one, debt to equity, looks at total liabilities over total equity. So if I go and look at how I calculated that, if you look at these green arrows at the bottom, I've got long-term liabilities, borrowings and a loan from member, and I've got short-term liabilities, trade payables, tax liability, and this current portion of our borrowings. If I add these two 1.6 millions together, I get total liability, and my total equity is here by the orangey arrow, this 4.5 million. If we just look at it like this, we can see that they are in a solvent position. Assets exceed liabilities. We have positive book value. How well or what is their gearing like? How much debt do they use in relation to equity? About 73%. Now, I mentioned earlier that your rule of thumb is about 50 to 50. You want 50% debt, 50% equity. So this might seem a bit high. But if you go and look at what their liabilities are actually made of, you can see that your borrowings, that 75,000 plus the short-term portion of about 300,000, gives you just over 400,000 Rand of possibly interest-bearing debt. The major portion of your liability is a loan from member, which will probably not be interest-bearing. And because it's a loan from the member of the CC, there could be a situation where if something happens in this company, you can maybe enter into a subordination agreement with a member, or you can negotiate new terms of that loan. So you can see, because it's a member loan, it has the feeling of equity, even though it's an obligation. And that's why I'm not too concerned about this high leverage of the company, because if you actually look at interest-bearing debt, it's quite low. So if, for example, just to illustrate that, I had to take out, see here, the 1.5 million. I've just put my cursor there for you to see it. If I take this ratio that I've calculated and I take my total liabilities and I deduct the member's loan, you can see that it drops down to about 39%. So the actual external or interest-bearing debt is quite low in relation to the equity in this company. We just, obviously, when we look at total liabilities in a complete solvency point of view, we actually we are going to include the member's loan. If we look at your debt ratio, we're looking at total liabilities over total assets in this case, which is here by the pinkish arrow. So once again, I'll take my total current and non-current liabilities, which is the 1.6 and the 1.6 million over here, and I will divide that by my total assets. So we are looking at which portion of your assets are being financed by liabilities. In this case, we're getting about 42%. That seems like it's inching up quite high, but once again, as I mentioned, a large portion of your debt is a loan to member, which has the feeling of equity because it's a lot more negotiable than with an external financial party or a financial institution. It might also possibly not be interest-bearing. So if in this case, I just want to illustrate it for explanation purposes, I then took out the member's loan again, 153,671. You can see it's only 20% of your assets that's really being financed by external debt. So in conjunction, if you look at both these ratios together, you can see that we are in a fairly strong solvency position, and we are not very highly geared. In other words, we don't have a very large proportion of debt in relation to the equity. I also want to illustrate the interest coverage ratio for you, because that's quite an interesting ratio to keep an eye on as well. In this case, we are saying you are taking earnings before interest and tax. So that would be here by the first blue arrow. So it's earnings before any finance items as well as your tax. So it's that 2295585, and we're dividing it by your total finance cost or your interest expense. In this case, about 39,000. If you perform this calculation, you'll see that we end up with an interest coverage ratio of 59, which is really high because anything above 5 is pretty good. But the reason for this in this company, once again putting it into context, is because the major portion of your debt is a member's loan. And this probably, if you look at your interest coverage ratio, you can see probably implies that this loan is not interest bearing because you don't have a very high finance cost in this business. Your interest bearing debt is really quite small. And so they're actually in a very strong position. Okay, I'm going to jump back to my slides. And we're going to carry on in terms of our practical considerations. And hopefully that has put the ratio analysis into a little bit more perspective and just shown you how they get calculated. What's very important is after you've actually calculated your ratios and you do have these indicators on hand in your business, what do you actually do with them? It's extremely important that you keep an eye on them. In other words, that you monitor your indicators. So typically in a business, I would think that you would need, or most of you, I would hope, do have monthly reporting. Your accountants or even yourself might prepare monthly management accounts. Management accounts are really a set of financial information that you need, preferably on a monthly basis. So usually it will consist of an income statement, balance sheet, probably and preferably some cash flow information, and any other type of reporting that is applicable to your business. It could possibly include a sales report if that is part of your business, or maybe you see that you're struggling with inventory turnover, and so you might want some reporting on that. It really depends on what you need in your business to be able to track your financial health. So management accounts and monthly reporting are very, very important, because without them, you don't actually have the information to go and perform liquidity and solvency calculations. Now, when we talk about financial reporting, we also need to think about the balancing act between accurate information and information that is very timely, because the longer the time after your results, the more accurate you can possibly report them. But if you take too long on reporting, then it actually isn't relevant to decision making, because you can't actually use that information to do anything. It's just too late. Now, I would really recommend that you use the financial knowledge and assistance of your accountant, especially when it comes to your ratio analysis, because the interpretation of these ratios is key. As I mentioned before, it's so important. That's why I keep saying it. Please don't look at your ratios in isolation. You need to look at it from the point of view of your whole business, as well as the context of where you are in the business life cycle, as well as your industry. What you need to do with your monthly reporting, and once you've calculated your liquidity and your solvency ratios and your indicators, is you need to actually monitor these. You need to look out for month-to-month trends. What are sudden changes? What happened in the business that could possibly suddenly throw out your analysis? Is this a short-term thing? Is it a long-term thing? And especially important are your liquidity ratios. These are crucial to monitor, because liquidity looks at a short-term view. So it's very difficult to solve any liquidity issues because of the short-term time frame that we are looking at. So it's urgent that you know or track your liquidity so that you can actually fix them when they become stressed in time for you to still remain liquid going forward. Always make sure, if at all possible, that you have a healthy bank balance. So you do keep some funds or reserves in your business, or at the very least, that you have assets that can be converted into cash pretty quickly. Just to give you an example, in terms of liquidity of cash or cash equivalents, you might have a long-term, or say, long-term is the wrong way to put it. Rather, you might have a fixed deposit, a 90-day fixed deposit. If you compare a 90-day fixed deposit with cash on hand, the 90-day fixed deposit will be a lot less liquid than the cash on hand, because you have to wait 90 days before you can actually draw that money out again. So it's just important also to consider the various types of assets or short-term assets that you have from a cash point of view and how liquid you are then. Always keep an eye on your solvency to not erode the value of your business or your equity. And that's why it's important to continuously monitor your solvency ratios as well. And it's also important to consider how these ratios will be affected in the future. So this is where your forecasting and your budgeting becomes very important. Do a profit forecast. Put into place, especially also a cash flow forecast. Put budgets into place and continuously monitor how you are actually doing against these budgets. And then you can actually calculate solvency and liquidity ratios on those forecasted numbers and see how you are going to track in future. So it gives you actually a very good picture of what's going to happen in your business so that you can make adjustments now to ensure ongoing financial health. So you can see the monitoring side of it from a practical point of view is very much not only a calculation, but also a strategy thing. Try and identify problem areas early on, and as I just mentioned, develop a strategy to remedy these, because that is the way that you are going to ensure longevity in your business. Also, always please be careful of commercial insolvency, so don't look at your solvency ratios without also considering your liquidity. What I wanted to just show you as well, just to kind of put it into a little bit more of a practical point of view, this is an extract from an actual credit rating application from a financial institution. So what typically happens is if you go to the bank and apply for financial assistance or let's say a loan, they will do a credit, you will complete a credit application, and this application is split into two parts: a qualitative part, in other words, looking at what your business is about, what do you buy and sell, how do you trade, what industry you are in, and then the quantitative scoring, which is basically looking at your numbers. And I just wanted to show you here in the top part that your debt management liquidity and asset management, as well as profitability and debt coverage. These profitability, liquidity, and debt indicators are actually weighted quite heavily, between 15 to 20% of your overall quantitative scoring. So it's just another indicator for you to show that your liquidity and solvency is so important to monitor on an ongoing basis, to make sure that it's healthy, so that when you do need financial assistance, or you do want to actually go and apply for a loan, that your business is in a healthy position to do so. Often you would hear business owners say, but I went to apply for a loan and it was rejected, and I can't understand why my application was rejected, because I have strong assets that I can use as security. Just remember that the bank is also looking at your liquidity and whether you can actually service the debt, both the interest and the capital, and not just looking at whether you've got security for that. So it's important to look at both your liquidity and solvency together, just to put it in a little bit more of a real world view. But what does that really look or mean in terms of my business? Now, it's all nice to say, okay, I've calculated my ratios and I'm keeping an eye on that, but what if I see that I'm running into trouble? What can I actually do? So from a liquidity point of view, how can you improve it? You can increase the working capital cycle. So as I explained earlier, your working capital cycle is the time it takes to convert your net current assets and current liabilities to cash. So here we are looking at your debtors, your creditors, your inventory cycle. How can we improve that? Try and invoice your customers as early or as soon as possible after the transaction or the sales transaction. Be diligent in following up your debtors. So you want to actually shorten the time between the sale and collection of your debtors as much as possible. Try and negotiate longer payment terms with your creditors. So let's say, for example, at the moment you are paying your suppliers in, say, 60 days. See if you can't push that to 90 days if you want to improve your liquidity. And if you look at your working capital cycle, just compare your debtors and your creditors always. For example, if you've got debtors terms of 60 days, but you need to pay your creditors in 30 days, you can already see that there's going to be a problem, because there's going to be a cash outflow before you get a cash inflow. So try and work it so that you have it the other way around. Possibly get your debtors at 30 days and your creditors at 60 or 90 days. And you can see that you will get cash in, which you can then use to pay off your creditors. Another way to improve your liquidity is to switch from short-term to long-term debt. Long-term debt means smaller installments, lower interest rates potentially, and your capital you can pay off much later. So you can see you are actually just delaying a little bit so that you've got liquidity in the short term to actually trade more easily. So you can put your liquidity to better use. Also, look at disposing of unproductive or underperforming assets. Now, you might ask, how do I actually identify unproductive or underperforming assets? Well, in a manufacturing environment, if that's the industry that you're in, it's actually quite easy, because you can look at physical assets, tangible assets. You can look at whether they need repairs often. How slow are they? Do they have downtime? Does it cost more to actually run this asset than the income it generates? But from a service industry point of view, you need to look at it a little bit differently. Because from a service point of view, you're actually selling time. So you might not have large, tangible property, plant, and equipment or assets, but you might look or consider your staff as being assets of your company, even though you don't physically own them. So in this case, when you look at underperformance, you need to consider becoming more strict on performance measurement and performance management of your staff, putting into place key performance indicators and actually measuring against those, being much more specific on your job descriptions and kind of managing that, because once you actually manage your staff or your workforce from a services point of view, or in a service industry, then you can actually maybe increase your productivity and your liquidity will improve as well. Another way to improve your liquidity is always to look at your costs, controlling your overheads and costs, because obviously the less you need to pay in the short term, the more liquidity or more liquid assets you have to then service your working capital. Another way that you could possibly improve liquidity, but it's not something that is necessarily applicable to all businesses or in all instances, one needs to look at the circumstances of your business, is to look at any assets that are unencumbered. In other words, they are not put up for security of debt, and to refinance them. In other words, let's say you had an asset that you purchased in cash because you had the cash available. Now you see your business is actually running into a little bit of trouble in terms of liquidity. You can refinance that asset if it's unencumbered to free up some cash in the short term. It might be a little bit more expensive in the long term because there will then be an interest charge related to that financing, but it does allow you then to improve your liquidity, which you might need right now. Looking at it from a solvency point of view, how can you improve the solvency of your business? Well, the main thing that you need to do is try and trade out of insolvency. And this is where quality and good service become key. So your business, almost the qualitative or soft skills of your business become very important. And when we talk about trading out of insolvency, we are actually looking at focusing a lot more than on liquidity to keep going, to be able to actually trade through this difficult time that you're going through. So what's important then is to get a marketing plan in place. You need to increase your revenue and profitability, and at the same time, obviously, reorganize and manage your costs so that you can actually improve the results of your business. If you see that you are in quite a tricky position, maybe you can try and get some owner assistance in the form of equity investments, possibly a shareholder or member's loan, or some capital injection if that is at all possible, and try and avoid new debt. Because obviously, if you are in an insolvent position and you get new debt, it's obviously just going to make your situation even worse. So as you can see, when we are looking at improving solvency and improving liquidity, they do tend to overlap a little bit. And it's always in your business a bit of a balancing act because your business does go through cycles. Sometimes you'll have more liquidity than others. Sometimes you will be more solvent than others. And the important thing is to balance the two. Because if you are having trouble in both your liquidity and your solvency, you're looking at serious issues because to try and correct both at once is very tricky. Currently, we are sitting in unprecedented times, and the impact of COVID-19 is very real, and it's very applicable at the moment for all businesses across all industries. Many businesses are facing financial distress, and you might be in a position in your business at the moment that you need additional financing. But it's important to consider whether you can actually repay and service these additional obligations. So suddenly, your liquidity and solvency becomes more relevant than ever before. If you do go to the bank and you're looking for additional financing, a business plan is now required by all the banks. And this includes not only the financial plan, but a marketing plan as well. The banks want to see how you are going to trade out of this difficult time. And so it's very important right now, crucial even, to get a 12-month forecast in place so that you can see at least 12 months, even more if you can, to see where your business is going and how you can actually improve the financial health if you are finding that you are in financial distress. By keeping an eye on these ratios of liquidity and solvency and being very almost pedantic about monitoring them and looking at your critical management info, you can survive tough times. You can ensure that your business is sustainable. And that's why this topic, liquidity and solvency, is so relevant right now. You might ask also, when you're looking at cutting costs, whether you can actually afford someone to help you, whether it be a financial accountant, whether it is someone like a business coach or a mentor. Yes, it's vital. If you can, do it. Get help in if you see that your business is in distress, because it just puts a whole different perspective to your business, and it might identify areas that you might not have realized that you can actually improve on or that you can use to get out of these tough times. Hopefully, or as I said at the bottom, financial management and monitoring are key to surviving the tough times. It is possible if you keep a hand on the financial indicators. Hopefully, I have provided you with a nice overview today of why liquidity and solvency is so important. Please feel free to send any questions through. It would be great to hear some feedback from you in terms of how your business is doing. And we'd also like to, as BAN, invite you to our next client webinar series. It'll be on the 29th of July in our normal time slot of 9 to 10. It'll be great if you could join us. We will send out an invitation closer to the time to confirm the topic. Hi, Jolene. Thanks so much for your question. That's a very, very good question. No, you are correct. It's not the norm for all industries. And that's why I mentioned you need to look at these ratios in context, because each business is different, each industry is different. And if you, as you say, in the retail industry, if your quick ratio is below 1 to 1, but your industry is of such a type that you know that you are still going to meet your liquidity and you're still going to meet your obligations, then obviously it works for you. But in terms of from a generalized point of view, we usually look at 2-to-1. But yes, you're absolutely correct. Every industry will be different. Every business will also be different. Look, Paula, thanks so much for your question. That's a good question as well. I don't think that there's anything specifically that's published because every business is so different. But if you are, for example, a company, let's say in the construction industry, once you actually get, I almost want to say your accountant will be able to help you with this, because if you're in and if you work in a specific industry quite often, you will get a feel as you work with different companies and as you work in the industry what the norm really is and how the companies work. So it's a lot dependent on experience as well. I think if you start reading around, you'll see in the different industries that they do talk about different industry norms. But I don't know if there's anything specific, almost like a list that's published and to say, okay, well, in the construction industry, it should be this. In the services industry, it should be this. I think it's too black and white. The ratio analysis, as I say, should be put into context, not only per industry, but also per company. And so I think there are a lot of variables or factors that go into it. And so I don't think you'll actually see something published. It very much looks at, I'm sure if you do some research in terms of experience in that industry, you'll see some ratio norms coming through. But as I say, I haven't actually ever seen a published list necessarily.